Hey, this is Dave from housebarons.com, and today in our home buying series, we're going to look at the question, how much money do I need to buy a house? The answer to this question is a good news, bad news kind of scenario. So we'll deal with the bad news first. The reality is, if you want to buy a house with a conventional loan requires 20% down. So let's say, for example, we're looking at buying a house that's $150,000. 20% down means that right from the get-go, you need to have $30,000 of cash, but it gets worse from there. When you go to get a loan from a bank, oftentimes banks build in a lot of fees. There are $4,000, $5,000, $6,000 in fees that can occur as a cost of doing business with the bank. Though those fees can get rolled into your loan in some cases, it's still expensive and it still adds to the outgo. And we're still not done with additional fees. You also have money up front that you're going to need to pony up from. This is money that's going to be out of pocket. Typically, when you're buying a new house, whoever is fronting the money for the loan is going to want to make sure that that house is insured. And typically, you have to pay for that insurance up front, a year in advance. So that could be $500, $1,000, $1,500, depending on the expense of the house. You also have to include property tax. When you're buying a new house, property taxes have to be paid at least 6 months in advance so that there's a reserve to draw from when the next property tax bill is due. So that's also money that's going to come out of pocket. And there's still more fees. Now let's say we're at the offer table. We're going to write an offer on a house. The first thing you're going to have to do when you submit that offer is to put some kind of earnest money down. And that varies widely. If you're lucky, you might get away with $1,000, but it's not unusual for it to be at least 1% of the offer price. So on a $150,000 house, this is $1,500 that you have to write a check for and attach it to the offer so that when the offer is submitted, the seller knows that you're a very interested buyer and you're putting this money up front as a deposit. There are still more fees that you could possibly run into. For example, are you going to get the house inspected? We'll deal with this more in another video, but typically it's a good idea to get the house inspected. But that's upfront money that you're going to have to pay for, somewhere maybe around $500. Then comes the survey. Are you going to have the property surveyed, that your neighbor doesn't have something of theirs sitting on your property or vice versa? It's good to know the property lines, but that's not a freebie. That's something that's going to cost you add another $500 to your outgoing costs. You're going to have a title search and title insurance added to the pot. And now, once we get all those done, there's still a myriad of other miscellaneous fees that can be added on to either out-of-pocket money or money that's going to get rolled into the loan. For example, some lenders are going to require that you have proof of funds in reserve. That means they want to see that you can make the next couple mortgage payments. Say you run into some pandemic, or say you lose your job, or your income is delayed for some odd reason. The banks sometimes require you to prove that you have at least a couple months of reserve money sitting liquid in case you need to make that payment without other money coming in. If you are buying a place that say has propane fuel or oil fuel that is delivered by truck and then stored on the property, when a seller is selling you a house, sometimes they're going to want that money reimbursed to them. And then if you buy a house that's in, say, a neighborhood, and there are HOA fees, homeowners association fees, but you could be talking multiple $100s a month. Something to consider as you hunt for a house. So when you go and total all these up, it's a crazy number. Probably on a $150,000 house that we talked about, conventional loan, you got $30,000 in a down payment, another $10,000 or $15,000 in miscellaneous fees that are either going to come out of your pocket or be tacked onto the loan. This starts to add up very quickly and can be a deal breaker in and of itself. That's all the bad news. There is good news. We can repaint this picture and you can get into a house for a lot less than that $30 or $40 or $50,000 that we've already talked about. And here's how. Let's say you're not going to go the conventional loan route. There are lots of other ways that you can get loans that are government backed. A conventional loan is a loan that the bank is taking all the risk on. And so they usually like to have a lot of built-in safeguards, i.e. a big down payment, to ensure that you're not going to default on that loan. The FHA loan, for example, a government-backed loan, is insured by the government, and their rules for down payments are a little more relaxed and makes it easier to get into a house that way. A typical FHA loan might have a 3.5% down payment. Well, now you've taken what was a 20% down payment or $30,000 on a $150,000 house, and you've reduced it. So now you've reduced that amount to maybe $5,000. Well, that's a totally different scenario. And as you look at all the loan fees, everything that I told you in advance in our worst case scenario example, a lot of those things are negotiable. And some of those right off the bat are the loan fees. You can find lending institutions that don't require huge loan fees. And that's part of the shopping that you have to do to find your best case scenario. The upfront money, the homeowner's insurance, and the property taxes in advance, that's very common and kind of tough to circumvent. You really need to have or homeowner's insurance, and you're really going to have to pay those property taxes up front to have that cushion. That's pretty typical. But a lot of the other things are all negotiable, and when those closing costs start to rise, you could make as part of your offer to the seller, hey, I'll pay you X amount for your house, but on the back side of that, I want you to pay for some of these or all of these closing fees. And that's where the negotiation between you, the buyer, and the seller comes into play, so that you can get those closing costs reduced so it's not such a painful impact on your wallet. And then there's those miscellaneous fees. On an FHA loan or maybe another specialty loan, they may not require any proof of funds in reserve. You may buy a house that's not in an HOA neighborhood, and therefore you don't even have to pay any HOA fees. Or you may buy a house that doesn't have fuel tanks on the property with fuel already in them, and so you won't need money out of pocket to pay for all of that. Those are all factors that come into play when you're trying to figure out what am I going to buy and how much am I going to need to spend. But the picture gets even better if you can find yourself in a specialty loan category. By specialty loan category, I mean a category where the amount down is literally 0% down. A couple examples of these are a VA loan. If you've served in the military and you're a veteran, you may have access to a VA loan, which is 0% down and very low on fees. Another example of this is a U.S. Department of Agriculture loan. And a USDA loan are loans that are made by the government, by the USDA, and they are for specific areas, typically more rural. The USDA provides a website where you can actually go and look and see what areas are approved for USDA loans. And though they're typically rural, they're not sometimes too far outside of major metropolitan areas. So it's worth looking at, because maybe you could buy or build in an area and get a USDA loan. And those loans are meant for people who are lower income or middle income. And they are 0% down and super low on fees. And that makes it very advantageous if you're trying to get into a house and not have a lot of money out of pocket. One example I have here of a USDA loan that I saw, the actual difference between the purchase price and the final funds price of the house was only a difference of about $1,400. Add to that still the home insurance, you were still probably around $2,000 out of pocket to do that loan. When you think about it, that's a very reasonable amount of money to have to be able to get into your own brand new home. Those are things to consider when you're trying to decide how much will I have to pay to get into a house. The good news is it really isn't that expensive in the grand scheme of home ownership. Now, there's one warning about this, and that is this. Once you get into a house, the demand on funds don't disappear. And let me give you this example. A friend of mine bought a house, and once they were done with all the things that we've talked about here, and they were moved in, 2 or 3 months after they were moved in, they found out that one of their sewer tiles, the drain tiles that go out to the city sewer, collapsed, and they had a $4,000 plumbing bill. There are all kinds of surprises you get into. Some will be found out during an inspection and you can negotiate through that process. Some are surprises that happen after the purchase and there's no possible way of knowing. And that's why it's good to know as you look for a house, have some money in reserve, whether it's required or not by the lender, because homeownership brings those kinds of surprises. The home buying process can be sometimes a little overwhelming, but with a little knowledge and a little bit of understanding of the type of options that are available to you, you can get into a house for not a whole lot of money. Just make sure as you do this, as you go through your house hunting processes, to do your homework and dig deep and negotiate well. You'll find yourself in a much improved situation. I hope this video helps. Stay tuned for more videos in our house buying series. If you got anything out of this, give us a thumbs up, share it with your friends. If you haven't already, please subscribe. Thanks a lot for viewing. We'll see you next time.